Hi folks, the topic of seller financing has been coming up more and more as a possible solution to deal with the high cost of financing in this current interest rate environment. So let's dig in. Let's see what it is and let's see if it's right for you. I'm Michael Minson with the Level Up Group. We're powered by Place and Keller Williams Luxury International. Stay tuned for a primer on seller financing after the break. Seller financing is basically where the seller takes the role of a lender and the buyer agrees to pay the seller back over time with interest, and the deal is secured by the property as collateral. If the buyer defaults on the loan, the seller can foreclose and take the property back. And now in this high interest rate environment, it may make sense for both the buyer and the seller to consider seller financing, as it can be quite lucrative for the seller and it can solve some down payment or maybe credit challenges for the buyer. Keep in mind, if you're considering seller financing, your realtor can help you negotiate the terms of the deal, but you should really have a lawyer review it and make sure you understand everything before signing. So, got that disclaimer out of the way, here's how it works. In exchange for the title to the property, the buyer agrees to pay the seller back over time with interest and some sort of agreed upon down payment. The seller records a lien or a deed of trust on the property, just like a traditional lender would. At that point, the seller becomes the lender and is no longer on title or responsible for maintenance, taxes, insurance, or really anything else related to the property. The buyer then pays the seller according to the terms on the note. Then that terms can really be just about anything the two parties agree, as long as it doesn't run afoul of predatory type practices like payday loans, for example, in California. Seller financing, first and foremost, requires that the seller have 100% equity or at least a very low mortgage relative to the sale price. If the seller has a loan, their lender will in most cases require that loan to be paid off at the time of the sale. So that money has to come from somewhere, which is usually where the down payment comes in. Now, if the buyer's down payment doesn't cover the seller's loan balance, the seller's going to need to find that money from somewhere else. So some things to consider, as this is not a very regulated process. So it's important that the buyer and the seller understand that they're entering into a lending relationship for some period of time, and that comes with risks and rewards. So let's start with the rewards. For sellers, you're able to collect interest on the money that the buyer owes you. That rate is determined by mutual agreement from both parties, and that happens during negotiations. Since rates right now are in the 7s or maybe 8s here in October 2023, you can give the buyer a deal by offering them a point or two less than current rates and make some passive income over time. Here's the math. $1 million loan at 5% is $50,000 a year, and you really don't have to do a whole lot other than cash those checks. Now, if the buyer is riskier and a traditional lender may not take them on, you could charge more than the going rate, perhaps 10 or 12%, which is comparable to a hard money lender, but that of course comes with a higher risk of default. If the banks won't lend to them, and if banking or risk management is not your primary business, you really should think long and hard if you really want to get into bed with that type of buyer. So what's the exit strategy? At the end of the term, the duration of which is fully negotiable, the buyer pays the seller back the balance of the amount owed. They usually get that money from refinancing or from selling the property. Now, both the buyer and the seller need to fully understand and be able to articulate what is the buyer's exit strategy. If the buyer is flipping the property, for example, do they have the cash to do the work properly so they'll have the equity to pay you back? If they're W-2 employees or self-employed, do they have a stable job and income history such that they'll be able to get a loan when that term comes up? So let's talk about what we've seen recently. Here's an example. Keep in mind, this is completely negotiable between parties. But we recently saw a deal where a seller was financing a mixed-use property. They gave the buyer a 5-year term. It was amortized over 30 years, meaning the buyer paid down the principal as well as the interest. They had a 20% down payment, and they had a balloon payment at the end of those 5 years. Now, balloon payment just means paying everything off what's owed at once rather than over the next 25 years. Now, that balloon payment can be a doozy, which is why the buyer has to have a very clear exit strategy, or you both could end up in a pickle. So let's talk about the risks. Now, the biggest risk, of course, is default. Even with the best intentions, sometimes folks get over their skis and they can't pay back their obligations. Now, as the lender, you now have to decide how to make something work. Your ultimate backstop is foreclosure, and That's a process that you should definitely not try to take on yourself unless, of course, that is your business. But there may be other options in between depending on the unique situation of the buyer. If you foreclose, the buyer loses the property plus their down payment and any principal they've paid down, which is why more down payment is better. That's their skin in the game, if you will. Now, a buyer that's in a bad spot may likely behave very differently if they have $500,000 to lose versus $5,000 or even nothing. And once you complete the time-consuming and stressful foreclosure process, now you have the house back to sell again. Hopefully it's in the same or better shape than when you sold it, but there are no guarantees. If it's a flip that got stopped midway, you could be sitting on a real disaster. So seller financing is not for everyone, but it can create a very helpful path forward for both parties where one might not have existed otherwise. Please, please, please consult an attorney before signing anything. We know some excellent attorneys that specialize in this area in the Bay Area, and they can help. And if you're thinking of buying, selling, or investing in real estate, whether you're paying cash or you're getting a loan, or even maybe you want to talk about seller financing in more detail, give us a call. We're happy to help.